Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, February 24th, 2020. All right, so let's pick up where we left off Friday. On Friday, we had the bear flags hit their measured targets as well as my first target there on QQQ, and we had a reaction there that stopped the selling cold that day, or just a hair under it, right around the bear flag measured targets, and expect a little reaction there. And we got it. We continued to trade Friday until the close of the after-hour session, right around that level, right on there too. Now today, of course, we gapped down pretty good. We had a nice drop in the futures overnight. So what we did is we overshot. This was what I refer to as my preferred near-term swing target or final near-term swing target at 224.70. That gap right there, and we had the uptrend line below. So we actually shot under that. I had a line here, which this morning in the update before the market opened, I had a dual gap. There, let me move this up here. Dual gap. Resistance and support right there. You had gap number 1 right here, gap number 2 there, and so what I did is I extended this trend line. You turn it on. I had that trend line there before and just made an extension. And that's where we hit this morning, and pretty much contained trading all day. You remember, when you're down almost 4% on the day, you're going to have big intraday swings. You can see the size of these candles. You don't see those back here when you're in a typical upward move. Usually you get that expanded volatility. And so basically that's it. I added one more trend line right here. It's a minor uptrend line. I'm not putting a lot of weighting into it because there's not too many reactions, but so far it's what held everything. So where we're at is, number one, the divergence has played out. Like I said, sometimes those divergences build, and then they play out for a correction. And then you set up, reset, pretty much do a full reset. We had bullish divergence on SPY right here. We almost had another low on QQQ, but we didn't. But on SPY, we had a divergent low that set up the rally here. And again, we had the first early sell signals here. We broke down, had a little kickback rally, but that went on to extend the divergence. So far, we're good for, what is this drop? Almost 4% today. And then what we had last week, that's about a 7% correction so far. So the biggest one in a while. And again, this market was kind of getting ahead of itself. With that whole FOMO trade, fear of missing out, and it hadn't had a correction in a while. So here's where we're at. Kind of have mixed views. Now, just from a pure simplistic point of view, we gapped down solidly below that trend line. That's the one off the October 3rd lows that I've been highlighting, and that's what I was targeting. And as I said before, it could eventually go, but we didn't even test it. We gapped right on through it. That's pretty bearish. This morning I was favoring, and I'm still leaning that way, to a kickback and a back test of the trend line. That would look something like this. However, we may have one more jog down, maybe not. To kind of summarize everything, and I did several updates throughout the day, 2 or 3 videos already today earlier, plus several charts for subscribers. We pretty much held the lows. That was it. If you weren't short coming into today, you missed the move, and there was not a trade. There was a little bounce trade to be made off the lows. I had mentioned that, covering shorts and reversing the long there for a bounce. We didn't get all of the bounce that I'm looking for yet. I'm still long. I see a little potential for a little more downside, but again, I covered my shorts and I went long there. I went long this morning and then added again at the open. Went long when my targets were hit, and then added on that opening surge down. That what you get there is a quick spike down due to the order imbalances, and then you can see the market kind of snap back up. So this is it. Here's the bigger picture right now. This was today. Again, most of the move happened on the gap, and then we traded sideways. That was a spike low at the open, which was 220.26, and we tested it once, and close enough right there. Where we go from here, I can coin toss it, but I'll tell you what I think. It is, again, kind of a mixed bag. Let me go here back to the daily chart, and I'll show you what I'm looking at here. Sometimes these levels come in very clear, where a lot of the key stocks as well as the indexes line up. That's not the case here. So let's just take this right now on face value for what it is. That is a breakdown below a pretty key uptrend line. We're kind of in no man's land. See this little doji? It's between That's not a hard support level because it's not super well defined, but there's some support there around 218.60, and nor are these levels here. Those are the gaps I just talked about right there. So we're kind of in what I call technical no man's land between support and resistance. What I do, I favor one way or another quite likely a back test, a kickback rally up here, maybe for a full back test of the trend line, but it may come on one more jog down in the morning before we get the reversal. On that, I am a little more than 50% for the up from here, and a gap up tomorrow and rally up and do that, then a move down. But I'm open to a little more downside. Let me show you what I'm looking at. So it would be that support level there, and on SPY you have a really nice support. So even though I prefer to trade the Qs over SPY because you get more bang for your buck. I've talked about that. We were down about 2% on Friday on SPY, and only not even 1% I believe on SPY. Same story today. SPY closed down 3.32 versus that 3.86 on QQQ. So to me it's simple. If you're going to go long or short, you're either going to be right or wrong on the markets, and if you're right, you're going to be more right, or make more money on the Qs than on SPY. Why? Because SPY is diluted with dividend paying, mom and pop, steady eddy blue chip stocks, utilities that tend to hold up or rally, defensive stocks, whereas QQQ is just tech heavy growth stocks. So when the market's down, and especially whether it's a one-day drop, not always, but most of the time, QQQ will outperform, and likewise when the market rallies, same thing. And as well as in the trends, if you're going to position for a trend that might last 6 months or a year, in almost all instances, QQQ will outperform to the upside or the downside. All right, so back to the levels. Let's go back to SPY. With all that being said, that's just me. That's my preference. I can tell you there are a huge subset of traders that only focus on trading the S&P 500 via ES, the futures, or SPY, or any of the derivatives. And so you have to respect what those traders are looking at. And that's, I have a pretty solid. Whereas QQQ, I'm a little not so hot on my support and resistance levels there. SPY, I see a pretty decent resistance. I've shared these before. These were potential targets, about 319.43 to 320.80, more of a support zone, if you will, and so that's what I'm leaning towards, is that one more thrust down, and so to try to quantify it from where we closed right now, where we closed today, you're talking not even a full percentage point, close to about almost 1%, we'll call it 0.9%, down to the bottom of that zone. Top of the zone is 0.5%. So the point being, I see limited downside till we hit a pretty solid support level where the algos, and the buy programs will probably kick in, and you'll probably get a decent bounce, a tradable bounce. So that's why I view the risk reward, at least for those not already short. The short here is not very good. Now you can wait till that level goes. This could happen. Let me tell you. We could blow right on through there. Like I like to say, support is support until unless broken. That's why we haven't hit that level since back here. We had a bunch of reactions here. So I favor reaction off that level. But if this happens, that's going to be pretty darn bearish. It's going to tell me that the supply-demand dynamics have shifted, and they've shifted very fast. They started to shift recently. Friday was, pretty good tell. And again, it was all priced in the charts. We were building these divergences, but what we have this time around that we didn't have before on these other little corrections, SPY had in many cases, or several cases, burned through some of the negative divergences that we're building, but you can see down here on both the PPO and RSI, we have clean negative divergence. If this chart is busy to you and you don't see what I'm talking about, let me just draw it out this way. Turn off all those drawing tools on the charting program and show you, right here you have the indicators, in this case the PPO, making a lower high. As I've mentioned on Friday, it was confirmed on QQQ and SPY via a bearish crossover. I like to see that because that puts in effectively a lower high, the previous high that is, and price is making a higher high. So there's our divergence, and that could and most likely will set the stage for a deeper correction. So I want to just say that the potential's there. And the thing about the market, since it's been so one-sided, it's been such a one-sided bullish trade with any and all bearish divergences, chart patterns, trendline breaks, resulting in they did play out for corrections, but very minor. The dips got bought aggressively and have been for most of the year, and that's just the last few months. You go back, you've seen that for a while. We had some more bigger corrections back here and all that, but for a while now, this has been the trend. So what happens? That creates excesses and imbalances. You get, and I'm speaking metaphorically, not literally, everybody's long, and when the last long has bought his or her share of stock, there's really no one else to buy, and at that point the shorts are blown out of the water. There's not a lot of put protection in the market. Everyone's buying calls because everyone thinks the market's invincible now and go up forever. That's what leads to these quick drops. They don't come out of nowhere. They're usually when the excesses reach a certain point, and then you have a catalyst. Like I mentioned, sometimes you have a catalyst that's purely technical. And I laugh when I try to see the media assign a headline like back in October of 2018. We had that was not a news-driven. What started that drop? It was pure technicals, and the analysts and everybody out there where they were scratching their heads to attribute the cause. And sure, there were a lot of theories thrown out, but this one is being solely attributed to, at least from what I saw in the headlines, the coronavirus cases now outside of China starting to increase. But again, that's not a out of the blue. That's not a black swan. That's a development, not a single event. This is a development that's been there for a while. With coronavirus has been out for a while now, and the market needed a catalyst to get going to the downside. And so the catalyst were the breakdowns last week when we had the sell signals. That put us in a downtrend sell signal. And so that's where we're at. So let me just wrap it up here for the indexes. I'll show you a few other things. This is a 60-minute chart. I showed you it on the daily. There's that 320.50 level. I've had this highlighted in yellow for a while. That's very good support. So again, I see limited downside. And this is showing us, I think I have the after-hour trades on here. Yeah, we do have after-hour trades. So this is wherever SPY is trading right now. And again, minimal downside to a pretty solid support level where I would put very good odds at a bounce or reaction. And being that we're at the top of the zone, it could start from here. So that's the thing. I look at everything from a risk-reward perspective. Why stay short for an extra 0.5%, maybe 1% in risk that we snap back and partially or even fully backfill today's big old gap? That's certainly a possibility. Like I said, QQQ, I still think it's going to come in and backtest this trend line. And to me, it's a matter, do we have one more jog down tomorrow and then do it? Or do we start moving up in the futures overnight, gap up, and then do it? So that's where, I'm going home. Where I came into the day short, I'll be going home into tomorrow long. Something crazy happens overnight, I have futures, I can manage those positions, whether it's with stops that I'll be asleep at 3 in the morning. If they take me out, so be it. But like I said, I'll give it a little more room to the downside. And then what I wanted to do in this video, we'll turn our focus, as I said we would, to the longer term charts. Subscribers, I did an extensive video today. I did hit on the weekly and monthly charts, showed you that the longest term trends are still solidly intact, not even remotely close to a sell signal. So you have to view this for the time being as just a correction within an ongoing uptrend. Until and unless those long-term indicators, particularly those on the monthly chart, get taken out. And I'm going from memory, but I think I said we were about 12 or 13% above the two most important trend indicators that I have on QQQ on that monthly chart. So again, we're not at risk right now of saying this is anything more than a correction. Anything's possible, so we'll play it by ear. I'd like to see what happens tomorrow. We didn't get the lift into the close today that I thought we would, but nor did we go down. Again, we look at this was the open right here at 220 right there. I'm sorry, the spike low after the open, tested it, and so we kind of went sideways all day. So the market felt very heavy, and I won't be able to really read much more into the charts until I see which way it goes tomorrow. If it does go down, is it contained, like I said, within 1% or so to the downside before we bounce? If not, something else is at work here, and what happens is the more we go down, more stop loss orders on longs get hit, more shorts get emboldened, and we could, it could accelerate the selling. But so I did want to point this out, that as of now we have some more powerful sell signals than those that I pointed out right here recently when we broke the, these were shorter term sell signals that got us to where we are. We broke those 60-minute trend lines. This is a daily chart. I'm just adding where the 60-minute breakdowns were. And then now we have a breakdown on a daily. That's more significant. So that tells me that even if we go and back test the line, or at most, I think right now, most we go up and we backfill today's gap. That means we go up to the bottom of Friday's candle. And those could come in together, by the way. We'll zoom in tight. You'll see what I'm talking about. We could do both by moving up here, come in there. Depends on, well, it depends on when we got there. We'd have to get there about this point and then head down. So that's about 229.07. And unless the markets can jump back up there quickly and regain this and make this just a one-off event, then this is a pretty ominous sign. All right, we're going to just go through the top components of QQQ very quickly. I don't want to spend too much time, but I want to say that I'm seeing a little bit of a mixed bag of technicals here. So here's Apple. Probably it is probably the single most important component of QQQ, but it's, the others are right there with it, Microsoft and Alphabet. Apple is above trend, and that reinforces my outlook right now that downside is probably minimal. It'd be a little bit more to get there on Apple, but you can see that we have pretty nice trend line support below, about 3% below. That's a trend line off the June 6th low, June 6, 2019 low. Same story. This was technically priced in. There's your negative divergence on Apple when it hit that high. There was your earnings pop, and that was it. And I talked about it at the time. I remember Apple years ago, several times I've seen them do this, where they come out, blow the cover off the ball, fantastic earnings. I mean, Apple is an earnings juggernaut. We all know that. And but what happens is after an extended uptrend, you have to ask yourself, how much of that phenomenal earnings growth in the blowout quarter was already priced into the what is that, 135% rally off the lows back in December of 2018. So that was it. That pop, you zoom in close, there's the earnings date, but they report after the bell, so this was the first day after earnings. That was it. Whoever bought the Apple earnings is now down, depending where they bought, they dropped as much as 10%, over 10% today. So what I see on this chart, 303.65, pretty decent support shelf taken out today and kissed at the highs, but we're still below it. That puts Apple in a fairly precarious technical posture, although we do have a pretty key uptrend line just below. The divergences on the daily say we could go down more, but I wouldn't short Apple right above support. I'd want to see that trend line go. I'd want to see the markets break down a little more again. So I'm favoring a little bounce. You can see if Apple wants to backfill the gap, it's right about there at about 310.84. That's a likely bounce back target. And what it needs to do to really open the door for more gains, you have the previous highs, both the post earnings rally on the 29th, the day after they reported, and we failed there again recently right here, and that's been the ceiling. So that's about 327. So those are your levels to watch on Apple. If it could somehow recoup all those, that's nothing but bullish. If it did it doesn't mean the stock's going up another 30%, and what it'll do if it does it soon, it will simply extend these divergences down here, and it will give you much larger divergences. I'm having a hard time with these tools today. There we go. You'd have RSI divergence and prices going higher like that. I know, lots of possibilities. So I'm taking it one day at a time, and I'm just looking at this pretty key uptrend line support below, and not a lot below that. I'll tell you, you've got price support down here. This is the big level, and I want to say this now. If things get really ugly between the point of this video and tomorrow, that there are two big levels on Apple, and it's probably going to see those sooner than later. And that is the 200-day EMA. This has done a great job at defining bull and bear markets in Apple over the years. You want to buy pullbacks to the 200, especially if you put it up on a weekly chart, which would then be the 400-week EMA. I'll show you that in a second. And you had that 255.74 level. So this would be, we'd probably, if we fell hard to hit it, we'd probably overshoot it intra-period and then close on or above it that day or the next day. But that's about a 13, almost 14% drop from where we closed. That's the if things get ugly. I just want to point that out, and it would also have taken out this trend line. Apple on the weekly chart, you can see it's a busy chart. I can turn all that off. This red line does a good job of defining the bull and bear trends. There's the 40-week. So usually when you're in an uptrend, the 40-week serves as support, and then once you break it, that's a bad sign. You can have some whipsaws. Nothing's perfect, but during the uptrends, that's when you want to look at it. During strong uptrends, it acts as support, and then once broken, boom, the trend changes, and then it's resistance on the way down. So just a great moving average over the years on this stock and certain tech stocks and the Nasdaq 100. And again, so we're way above it right now, and that's the other thing. When a stock goes in an uptrend for a while and it walks quite a bit away from the moving average, there's a reversion to the mean. In fact, I've covered that in the past. I have an indicator that I set up, a custom indicator to show me the percent that a stock is above or below a key moving average. And this one I just put up here. Oh, there it is. The line populated. It took a second. That red line is in recent years, when Apple has gotten that far away in percentage terms, which is 37% away from its moving average, 40-week moving average, that's often where you either started to correct or you put in a marginal new high and then corrected. It just tells you that the stock has walked quite a bit away. And if you're looking when to buy it during corrections, you just look for an extreme reading about 18% below the 40-week moving average, and that's when you want to step in and buy Apple. You would have been rewarded there, and here. Those were the best times to buy in the last few years. And so if things start to get ugly and you've been waiting for a long time to buy Apple and just didn't think you had the chance, that's something you want to look for down there. But we're quite a bit away from there now. Okay, let's just look at the rest of the FAANG stocks, because as I say, if you want to know where the market is going, if I somehow wasn't allowed or able to look at any charts of the S&P 500 or the Nasdaq 100, I could trade the NDX just looking at these 5 stocks. I call them the FAANGs: Facebook, Apple, Amazon, Microsoft, and Alphabet, which is the G for GOG. In this one, you can see here you have an uptrend line that comes off the October 22nd low, fairly well defined, and we broke down. So this is why I'm saying there's sort of a mixed bag in the charts. You're seeing Microsoft broke down, tried to regain it, but couldn't regain it. It pretty much closed a little bit below it right there. It could snap back tomorrow, and if it does, same story. This is what a lot of traders will be watching. I did not try to grab that tool. I wanted to grab just a horizontal line. You have these gaps right here. In the case of Microsoft, it's double gap resistance. So if we start to rally, a lot of stocks have today's gaps to contend with at the highs, and that's also resistance from another gap recently on Microsoft. But if it can get above there, this would be a one-day wonder. It would regain that trend line. That would be a whipsaw signal, bear trap. So near term, again, I'm kind of leaning towards the upside. Even if there's a quick jog down in the morning, let's say we gap down in the morning, and as much as 1% or so in the indexes, I think they'll step in and buy it back up. Anything much more than that, like I told subscribers this morning, don't get married to any one thing the market must do. These are the times you can make a lot of money. There was a lot of money to be made. I put out quite a few trade ideas today. Crude oil, we had a nice rally off the lows there, and that's after closing out the long last week, sidestepping this big correction, and some of us even shorted it on the way down recently, and again it gave a bounce trade off support. Maybe I'll get to that in a second if there's time. Gold and silver, we've been long and bullish on those until today when I said looking for correction if the markets start to rally or hold support, and we did. We had nice pullback trades there. Amazon fell to support about 1998 or so. With I'll give that price support a bigger weighting. It's the top of a big old gap right there. So here's a stock like Apple was just above trendline support. Amazon's at gap support, held it all day. Microsoft was just below support. So that's what I mean by a mixed bag. Normally I'll see when these stocks break down, they all break down at once or within close proximity. Or if they hit support, they all hit support at once and rally, or very close to it. In this case, you have Alphabet, this is GOOGL, the Class A shares, coming in. It took out this trend line with conviction. That trend line is virtually identical to the same trend line on QQQ I showed you off the October 3rd lows. Very well defined. Boom, that's a breakdown any way you slice or dice it. We're well below there. But look where that little doji printed, the body printed right on that 1422 support. So again, kind of a mixed bag. Yes, a sell signal, but also hit support. I often talk about giving, when you have two support levels in close proximity, giving the benefit of the doubt to the second one, because that break of the first one may prove to be a whipsaw if that second support level holds. So same story. Any snapback rally, you still have the trend line to contend with from below as potential resistance. You also have the top of the gap there, which is a little bit above. It's about 1480 or so on Alphabet. If it can't regain that level, the breakdown sticks, it's valid, and we're going to drop, and I don't see a whole lot of support. Minor support about 1365, but more decent support, which we'd probably hit. Big old thin zone on the way down, about 1335. So this is, if it gets ugly anytime soon, that's about another 6% drop in Alphabet. Doesn't mean that would have to be the floor. You can see some other potential levels here. But so, bottom line is maybe keep it light. Whether you're long or short, and see how things go tomorrow. There's a breakdown on the other share class. I don't have the horizontal lines there. I could add it, but that's GOG. I haven't updated this chart in a while. I need to clean up some of these levels. I'll do that later. And I usually focus on GOGL. And then Facebook right there. Gap down below support. Although we'd had a previous reaction low right here, so you could give a line right there and call it a support zone and right on it. So, Facebook has been zigzagging lower since they reported. So the common theme here is earnings, so far this earnings season has marked a top, whether it's going to be a major top in the market or just a near-term top. But a lot of these stocks, not all, but a lot of these market-leading stocks, that was it. There was your January 29th earnings. Actually, Facebook gapped down afterwards, but the earnings date marked the top. And so far we're zigzagging down. Is it just an ABC correction with more upside to come, or is it maybe the start of a 5-wave, corrective wave? Who knows? We'll see. And that's it for the equity markets. One other thing I wanted to show you. Well, I was going to show you that here's that CL trade, where we went long recently, exited right there, nailed the exit on the official long on USO, and so those that trading CL reversed here. Ran it down to that 52.46 on Friday, took it, reversed it long for a bounce, got out. Thank goodness, fell more today, but then able to take a long here at that 50.76 support I covered during the video, and that was it. I just looked for a quick bounce right up there, that 51. I added that line since it was nice resistance there. And one other thing I wanted to show you guys on the markets. We'll get into TVIX because we have an official trade on that. We're long TVIX. But as I mentioned in the video today, VIX ran into resistance. This is another reason I'm looking for a potential bounce in the market here. You can use the VIX to kind of help align trades on the equity market. What I'm talking about, this level has been on my chart for a long time, 25.58. I see a lot of reactions on or around that level, including that last spike high on the VIX. It does not mean we cannot go through there. That's the way the VIX works, but sometimes you'll blast on through resistance level, but more often than not, as I just showed you, 1, 2, 3, numerous, this is a half dozen at least tags at that level, have produced reactions. Even if, in this case, we hit it here a couple times, pulled back, hit it, pulled back, finally broke through it. Here we blasted right on through it. I'm leaning towards something like this if we do break on through there. So again, this puts me in the camp leaning towards a bounce tomorrow, whether it comes on a little gap down first in the morning or not, maybe a gap up. And but as I said, there is the potential in the charts. I'm not going to tell you I have the 100% confidence. There's potential in the charts that if we just melt down the futures tonight or whatever, gap way down, take out those supports that I just showed you that are coming up on Apple and SPY, for example, especially the big index support levels, we could do that. So I mentioned that to those on the site. If you wanted to book profits on TVIX today, which was up, let me check. All right, I turned off the price targets on here, but we were up 37% today. We've cleared our former first target where it was hit back here quickly. Like I said, because of that, the fact we hit resistance, certainly objective place to either take profits where I normally say you can raise stops, which you could. The problem with that is if the market were to gap up tomorrow, TVIX is probably going to gap down. But with that being said, the VIX is in rally mode, and once the VIX rallies, that's when you need to be on alert. It means the volatility, the low volatility, short volatility trade has broken, and we're coming off the divergent low, almost identical technical posture. I marked all these divergent lows over the year. Divergent lows, rally, 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 rally. Divergent high, you want to get out. Divergent low, rally, rally, and a divergent low. So the question is that it? Or are we going to see something like this? And of course, you can't rule out anything more. I don't foresee that right now, anything much more than this. But like I like to say, the charts are dynamic, and so is my analysis. So if we don't get a bounce tomorrow, if there's much more than 1% or so downside on the broad market on the S&P 500, then we could start breaking some floodgates here, meaning stop clusters, things like that. You get the margin unwinding, but again, that's not my preferred scenario right now. My preferred scenario is to be long going into tomorrow, mildly long, I should say, not aggressively long. If like what I see in the morning, I can always add to it, whether that means we open up or we actually go down, hit that target on SPY, and then go from there. I can manage my stops slightly below that, somewhat below that level. And just keep in mind, with expanded volatility, with this, when the VIX is up here in the $25 range, if you're trading and you're using SPY or ES or NQ and you're running a 1/4 point or a 0.5% or even a 1% stop, you're going to get taken out in the daily, in the grinds. You need to use a little bit wider stops. And the way to do that, just keep your position size a little lighter. When the market drops, NASDAQ 100 drops over 3% in a day, and you have a few contracts NQ, you're swinging up and down thousands of dollars, every 30-40 minutes. You don't need a lot. You don't have to commit a lot of capital to make as much money when volatility is high like this. So we'll wrap it up here. Subscribers, I'll post another update. Throughout the Netflix short at the golden shorting line the other day, that played out well so far. We hit our first target today, almost to the penny, bounce there. I will follow up with updates on that and the other official trade ideas either later today or tomorrow early. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.